Well, welcome to the Wisdom of Wealth podcast. My name is Kyle Kempers, and I'm excited today because our conversation is a relevant one. We have guests on the pod today. We have Jonathan Wield, Olivia McGraw, and Jack Carlson. And our hope is to dive into annuities and why annuities is not just something that you want to learn about, but maybe something that you want to research and lean into a conversation with an expert and professional on. And so to tee up this conversation today and give us an idea of why we want to talk about this, Jonathan Wield has graciously offered to give us a little market update and bring us up to speed on annuities.
Yeah, thanks for having us on here, Kyle. I mean, honestly, I never thought I'd be doing a podcast about annuities. It was always kind of like the dirty word, like it was like leasing a car back in the day. Like, oh, which dummy would lease a car? We all know that's a bad idea. But man, it's been fascinating looking at the landscape of annuities, specifically fixed index annuities, and the benefit they can be, especially for people in near or at retirement age. So looking forward to the conversation today.
Before we get too far into it, something that I thought was interesting about this conversation is that each one of us are specialists in the infinite banking concept. And it's kind of an odd thing for someone who's put their time and energy into becoming an expert in one specific field to then broaden that scope of work and offer something else. So Olivia, and I should also point out that we all work together. Bridled Wealth, Jonathan is the managing partner of it. And Olivia, would you give us some context on why would an infinite banker want to talk about annuities right now?
Yeah, great. I feel like this is, first of all, just something else that is near and dear to our hearts because as infinite bankers, we're very concerned with guarantees. We're also concerned with predictability and protecting what people have worked so hard to accumulate. And we know and have seen historically, and we talk about this with infinite banking all the time, that cycles happen in the markets. They're very not necessarily predictable, but we know things are coming. So, everybody talks about the Great Recession that started in 2008. And then, oh, wait, there was something in around 2015. And then after COVID, we saw another dip in the markets and things continue to climb and recover. But the problem with that recovery time is that if you are looking to retire, you don't have time to recover. That drop in the markets can mean a significant impact on your ability to retire when you want to and how much you have to live off of. And when those drops happen in the market, it actually has an exponential impact on what you've accumulated over your life and what you can draw from. And so that's why, as infinite bankers, we're talking about annuities because it's a way to actually preserve what you've worked so hard to accumulate over the course of your life.
Yeah,
Can one of you speak more, or Wield, you're gonna jump in and do it anyway.
I,
Give us a
I,
little more
I
like
was
meat on the
Yeah, I was
bone.
actually thinking about this because we've been talking about like the 2008 crash as the latest, big crash of our lifetimes. Obviously, I think we all remember 2008, 2001 happened. I remember it, but I was a little younger then. So it didn't impact me as much. But in 2008, what was interesting is there was still so much confidence in the market in the S&P 500 and big mutual funds, etc. And you saw such a significant drop. So I actually did the math. If you let's say you had $1 million in a 401k in the S&P 500, and granted you probably wouldn't have had it all in one index, but for for an example, in 2008 you would have dropped down almost 39%. It wouldn't have been until like early mid 2013 that you would have got back to $1 million. So you're talking like a 4 to 5 year delay. So picture the moment you're like, first off, with conventional wisdom right now, you can take 4% of your qualified plan per year in retirement for the rest of your life. So if you had $1 million, that's $40,000 a year. It's not as much money as you would think in, again, conventional wisdom. But imagine that 40,000 would have actually become like 23, 24,000 if you had wanted to retire. So the number of people in 08, 09 that either had to delay retirement 5 years or go back to work to try and get there. And that it's just a really sad thing. Again, to Olivia's point, is people who've worked their entire lives building up this account with great trust in the American economy and the stock market and the public markets. And really because of some bad actors, it delayed or deferred people's retirement for multiple years.
Yeah, to piggyback off that, yeah, like you're speaking to sequence of return risk. Like if you get close to retirement and have a huge drop, your income is going to be significantly impacted. And that's why that 4% number seems small. Some are even saying it's a 3% safe withdrawal rate. So annuities really help to mitigate that sequence of return risk and longevity risk. People are living longer these days, and to be able to lock in lifetime guaranteed income is really significant. There's studies, found one, the Towers report in 2017, that showed people are happier if they have a steady guaranteed income stream. Policemen, educators who have pensions, like those are the people that are happy, content. They're not worried about what's happening in the market because that paycheck's coming in month after month. And that's really why we're talking about annuities. And yeah, not only how to preserve the principal, but how to maximize income and make those retirement years the best they can be.
Yeah.
Yeah.
Yep.
Yeah, that was a great point. And before we get going too much further on this, I do want to just point out that we need to talk about what an annuity is. And
That would
then
be helpful.
why are we talking about it? So what is going on in the current market? And Jonathan, maybe you can speak to this. What's going on in our current market that's made an annuity relevant for us to address today? And then what is an annuity?
Yeah, I think that's a great starting point. So yeah, if we're to take a snapshot of the market today, so we're recording this September 9th, 2024. So if we look at the S&P 500 as being a really good indicator of where the market's at, we're up in double digits year to date. We did have a decrease a couple of years ago in 2022, down almost 20%. But we're pretty close to all-time highs. I think the S&P 500 all-time high is like 5650, somewhere around there. I should have looked it up, but it's in that ballpark. And we're at like 5450 today. So close to the all-time high of the market, which is pretty crazy. And again, it's September. We're 2 months out from an election, presidential election here in the US. And so that always has a pretty big impact. But there's also these external forces of what we saw just a few weeks ago with the impact of the yen on the US dollar, the interest rate, very small interest rate increase by the Bank of Japan, and it saw a global sell-off in the market and produced a lot of fear. It's already recovered and gone up since then. We've got China and Taiwan, potential conflicts. We got conflicts in the Middle East. We got conflicts in Eastern Europe. We're obviously post-pandemic. We still haven't figured out how to bolster Social Security. Our interest on our debt as a country is more than our military spend. And yet our military spend likely needs to go up given the recent look at both cyber and satellite potential attacks from bad actors in the world. So I'm not a fearmonger, but all that to say, like, hey, there's a lot of things that can impact our hard-earned money in the market. And again, to the original point of like, if you're near or at retirement age, conventional wisdom is going to say, hey, you probably want to split, 50 to 80% of your portfolio in bonds, which are not producing a ton, maybe 4.5%, 5%. So we're already seeing a shift of like, hey, it's time to de-risk your portfolio as much as you can, have some in cash and cash equivalents, which granted today are earning a decent amount, 5-ish% in money markets. Likely going down probably this month. So we're at a really weird point where volatility is high, uncertainty is high, the market is high, and it means there's a lot of room to go down. So if I'm in my late 50s, early 60s, and I'm looking at this runway up to that guaranteed income time, I'm being really strategic and thoughtful. And I think what happens a lot of times is people feel inadequate or stupid when it comes to these things. And so doing nothing is their choice. And I think this is actually probably the time where we have more people turning 65 each day than ever before in the United States history. We're at peak 65 with all of these peaks. And so I think it's a really relevant conversation today, probably more than ever. And one more quick note on that. It also has coincided with distribution rates on annuities. Some of the guaranteed returns on annuities are the highest I've certainly seen in my career. And so to have this option of conventional wisdom where you're de-risking via a bond stock ratio in your 401k or IRA versus being able to shift into a product with a 0% floor, you can't lose money, guaranteed returns for up to 10 years, guaranteed lifetime income, no matter how long you live. If I'm in that position, I'm really interested in taking a look at it as that as a solution.
I wanted to jump in real fast and just explain that you mentioned peak 65. A lot of folks might not necessarily know what that is, but right now, I think it's between now and is it 2027 or 20?
I think that's right, yeah.
11,000 Americans are turning 65 a day, which is ridiculous. So that's that baby boomer generation that are ready to punch out, and they're ready to actually enjoy their retirement, which, by the way, retirement as we know it is actually a modern invention. You think back 100 years, families lived together, families pooled their resources together and looked after that older generation. That's no longer the norm. And so it's being able to kind of go to our parents' generation, which, yes, all of us are, we don't yet have any gray or silver hair on this podcast. So who are we to be speaking into us? So we actually care about that older generation, who are our parents, who are the ones that are actually looking at this situation and going like, oh gosh, what do we do if the market's dropped and what I've been accumulating evaporates overnight? Which I've heard about all the time. I've also watched my grandmother, who was ready to retire and had to go back to work working in a jewelry store. We've all seen those older folks working in Walmart or other places just to make ends meet. Why? Because the retirement that they had accumulated either isn't there, or they didn't plan well, or something happened. Social Security wasn't meeting what they meant, the cost of inflation, which is a very real problem today for those of us who are still working. So even more if you're on that fixed income and you're ready to be drawing off of that lifetime savings, and all of a sudden prices of everything you need to live off of are skyrocketing, you have to make cuts somewhere. And so it's just saying, like, don't put yourself in that position. Set yourself up for a really successful retirement so that you have a power card in your hand to know that, okay, regardless of what happens with Social Security, I have a plan. Regardless of what happens in the markets, at least half of my retirement is tucked away into something that we affectionately call a 0% floor IRA, where it can be, yes, qualified money. Yes, it can be just regular money that you want to move over and protect. And it's still going to grow, but it's not at that actual market risk.
Yeah, you make a really good point, Olivia, because I agree with you. Each one of us on this conversation are thinking of somebody that we love and care about, and we want to do our best to educate ourselves on what's available to them so that we can help them. I just had a client this week who reached out and was like, "Hey man, my mom is like just trying to figure out stuff. She's in her early 60s, and she has an annuity, she has 401k." And we started talking about her portfolio. And it's just like the level of like desire that he had in expressing in this conversation of figuring out like what's the best option for her. And her annuity was an older one. So we're going to sit down together and just take a look at everything that she had available to her, because the conversation has changed just with the interest rates. And I think it'd probably be good to touch on some product specific details with annuities right now. I know Jack has some of the information. And so, Jack, would you be able to kind of give us a little bit more around what's going into the product and why do we care about this as a viable option for clients as well as loved ones?
Yep. Yeah. So annuities are typically contracts from a life insurance carrier that guarantee you income either for a certain period or for life. We've talked some about a fixed index annuity. I'm also setting a client up with something called a single premium immediate annuity. But both these plan types can be funded with qualified money. So if you have an old 401k or existing IRA or Roth IRA, you can roll into one of these annuities and that annuity keeps the kind of title of an IRA, but it's within the shell of an annuity now that can guarantee income and have the index tracking with a 0% floor. So yeah, the product that we have been using the most on our team from one of our preferred carriers is a fixed index annuity, and they actually have a 10-year 7% annual growth guarantee in place right now, which is super significant. Jonathan was just talking about, like,
Yeah,
as
that is
you
insane.
yeah, it's amazing. And as you near retirement, you're moving money to cash to de-risk your portfolio. Why not move that money to a 7% annual guarantee, that then when the time comes to start drawing income from that asset, you're getting more like 6 to 7% of a payout each year, rather than just the 3 to 4% safe withdrawal rate if that money stayed in the market. Um, there's also a really significant like withdrawal rider that allows you to, if a long-term care need arises, actually double the income that you're receiving. And that, I mean, when you when you get to retirement age, that's when healthcare costs are typically going to come about at some point during retirement. And to have a product that will double your income and help you get through those times is also super significant. One other thing I wanted to say, just to kind of put rubber to the road, I have another client who's about to start a 20-year certain period of a single premium immediate annuity. He's just dumping about $1 million into that product one time and receiving a 8.2% withdrawal for that for 20 years. And that's incredible to get 82,000 a year off of $1 million. So yeah, that's like, we want to set people up to win in these years. And yeah, the term retirement, I don't think any of us love that. It's like to be taken out of order. I think future cash flow planning is what we want to help with, and annuities are great tools to make that happen.
I wanted to touch on something with that on the 7% guarantee, because as we've already been talking about, like the risk for somebody nearing retirement to have like an option, and 7% isn't the maximum, right? With that product, 7% is the minimum. It's the worst case if you then start taking the lifetime withdrawal benefit from it. And so if you have somebody who's 55 years old and you're like, hey, I want to start taking money out in 10 years, to have the peace of mind, like I know that basically my money's going to almost double worst case in the next 10 years. If I've got $500,000 today in a IRA, I know that that's going to be at $1 million, and then I can take what, $60,000 to $75,000 a year guaranteed for the rest of my life. That is a big deal. And I think that's why we're having this conversation, because you didn't have that as an option 5 years ago. That wasn't the product option. That wasn't the distribution factor. You didn't have all those guarantees. So I just think it's a really, really cool option.
As we kind of wrap up this conversation and we near the end, I want each one of you to be thinking about, is there anything else that you didn't get the opportunity to say that you want to say? And then whoever wants to take this question, I think it's important to ask, how do people know if they're ready, if this is something that works for them, and then how do they approach it? Outside of obviously reaching out to someone that is educated on annuities. I mean, each one of us on this call today are highly educated in this space and would like to help you. But outside of that, how does somebody know, like, this is approachable? How do you even get one started? What does it take to get into it? And then so any one of you could respond to that question, but I'm just curious.
I'd love to jump in. First of all, I just want to say an annuity is a life insurance product, but it doesn't require that medical exam. So let's say you've gone through underwriting and you were denied coverage, you can still do this. It doesn't matter. How it ties to life insurance is a whole nother conversation that we don't have to have today. But it's a way to protect against two things. Number one, dying too early, because there is actually a death benefit associated with those annuities, and living too long. So that's living too long and not having enough income. So I would say that we're really looking for folks that are probably anywhere in the 40. You actually can't buy one until you're in your mid 40s. So mid 40s onward. But anyone who really is concerned about that principal protection of, like, how do I protect, even if it's just a portion of what I worked so hard to accumulate?
Yeah.
What?
I'd also say,
Okay.
in that, like starting to work backwards as you get close to retirement of like, what are my fixed expenses? Like, is there an amount that would feel really good to have guaranteed income coming in to cover? And then looking at the mix of assets you have, whether qualified plans, brokerage accounts, and seeing what's the lowest hanging fruit that we could like, oh, roll these two RAs into one annuity that would spit out 40,000 a year 3 years from now to get us off on a good start in retirement. That's kind of how I would look at it. Application's pretty simple. Looking at your risk tolerance and time horizon, but it's not difficult.
The only thing I also wanted to add here was if I've had a few clients who, again, because they've just had bad experiences with annuities or even have existing annuities. I had somebody who, it was actually a friend of mine's mum, who has an annuity and it just earns 3% a year guaranteed. And it's just ongoing, had it for a while. And it was back when 3% was good. And so he asked me, because he was like, man, I really think she should be making more than 3% in her annuity. So we reviewed and we're able to do a 1035 exchange. So basically not creating a taxable event. We moved the account value of her annuity into one of these new ones. It was actually one where it still had that 0% floor. It could not lose money if the market did crash, but she made 9% in the S&P 500 that first year. And so she basically made 3 years without any risk, made the next 3 years of growth if she had just left it in her existing annuity. So even people that have existing annuities, and maybe you did buy it a while ago when rates weren't as favorable, distribution factors weren't as favorable, now's a great time to review them. And there's often the opportunity to transfer it over into a more favorable one.
I just want to wrap up with this one thought that I often say this on the life insurance side purely, that not all life insurance companies are created equal, not all products are created equal, and not all designs. And that is the exact same thing when we're talking about annuities, that there are different products out there that actually can still keep your money at risk. And so this has everything to do with the kind of company, which is our job. We shop the best companies, we know the products that are out there, and we're making sure that they're set up in a way to function the way that you're hoping they will.
Yeah, that is well said. Thank you, Olivia. Thank you, all three of you guys, for creating the time, taking the time to sit down and have this conversation and kind of just create some starting points for this discussion around annuities. And if you're listening to this pod and you don't have one of our contacts informations or you didn't get referred by us, the easiest way to get in touch with us would be unbridledwealth.com. And you can just go to the About Us, find the agents page. You'll see all four of us on there, and then a few others on the team. But yeah, feel free to find us, reach out to us. And thank you so much for taking the time out of your day to listen to us babble on about annuities and how excited we are to create protection and legacy and guaranteed income for loved ones and clients. We'll see you on the next pod.